So we'll get this started pretty quickly rather than lots of preamble. But James has already introduced the panel. But what I'd probably quite like to do first is get everyone to introduce themselves, their funds, what they invest into. But I think I might ask a quick question first, which is now a good time to invest? One sentence answer and then introduce yourself and what your fund does. Lucy, I'll go to you first.
I'd say it depends on your business. Nice classic vague answer there. So I'm at Foresight. We have quite a wide range of investment that we can do. We go right the way down to the early stage ventures, right the way through to buyouts, and we've got different funds for each of those.
Ashley?
I would just say yes. Nice and succinct. So I'm the head of origination at Guinness Ventures, nothing to do with the brewery, just to preempt the inevitable question there. So we are EIS VCT, manage about 300 million on the ventures side, have a portfolio of about 50 companies. We're looking for early stage scaling up companies, typically million plus revenue, any sector, check sizes 1 to 3 million, relaxed about whether we lead, follow, go solo, can take it case by case, and we'll do 10 to 20 deals a year.
So the answer to the question is a bit like, is it a good time to have a baby, right, or move house? I think sometimes you just have to do it, right? So I think the market is definitely not as strong as it was 10 years ago. So, but it depends what you're doing, right? So I'm Vinay at Channel 4 Ventures, corporate VC, alternative to institutional funds. So we invest actually our media to our media alongside. Actually, we've done some deals, haven't we? Actually, but we invest our media alongside other funds or Crowdcube to scale companies. We're not stage specific. We reach 50 million people, and right now investors really get themselves in a right pickle over marketing and marketing costs, and we're here to alleviate that pain. So our assets can help reduce the marginal cash costs of marketing, and so we've got 100 million under management, 40 odd assets, and we're actively deploying. So 2 to 10 million, say.
Perfect. And I might as well just give a quick intro of me in relevance. So I'm an M&A advisor. So the end goal is looking forward to an exit. So realizing all the value that you've hopefully all built in your businesses. But it is helping on the way. So advising around growth capital and pieces like this. So probably my first longer question, where you can take a bit longer to answer everyone, is one of the first questions I get for a lot, where people come to me, they go, I've been really struggling to raise. Nobody says I'm at the right stage for them, or what do I need to be doing? I'm not big enough, or what's happening? So I'm going to throw it out. Lucy, I'll just go to you first as you're on my left. But what do you look for? What are the KPIs? What traction do you need to see from a business for you as Foresight to be interested to invest in them?
So this is actually a really difficult one for me to answer for Foresight, because we have such a wide range in what we do. So we've got 3 billion under management in terms of across our 3 sections. I'm assuming most people in the room here are probably more interested in the earlier stage investing that we do, which is the ventures funds. Those ones will quite often not have that much traction yet, so you don't have that many data points. And then we're looking at, you've got to have some revenue, some proof of concept, and then really we want to see as much data as you have. So can you tell us about your customers? Can you tell us about your sales cycle? Can you tell us about your competitors, where you sit in the market, whether you own your technology, how much it's going to cost for you to develop your technology, when it's going to be ready? Things you probably don't actually fully know yourselves, but if you can give us any data points, that's helpful. And then where I get involved, I tend to work more with the slightly more advanced businesses, where it's the growth and buyouts. And then that side, it's again all about data, but there's normally a lot more financial data at that point. So a lot more about profitability, your revenue mix, your the investment plan for the cash that we're putting in.
Ashley?
So I'll answer this from that sort of classic scale-up Series A perspective, but a lot of what I say hopefully will also apply to earlier stage. Our default view is teams, not themes, or people first, businesses second. So the smaller the business, the more important you as an individual are, you as the team you're building. So being able to really showcase who you've brought in, not just below you, but alongside you and above you. So who's your advisory board? Who's your chair? Who's your co-founder, for example, or CTO, CPO, CRO on those sides? So show you can recruit and retain talent is really important. Teams are scalable, individuals by themselves are not. So that would be point one. Secondly, in terms of metrics, I will give you a couple from the VC perspective to put everything into context. I see about 1,500 pitches a year, and we will do 10 to 20 deals. That's not uncommon for a lot of VCs. It's less than 1% of the things we see we'll say yes to, but only about half of the ones we see, it's about 700 or so a year, actually meet our headline criteria of EIS VCT million plus revenue. Doing your diligence first on those VCs is really important. The average VC investment will last 2/3 the length of the average marriage in the UK. And depending on your age, you're going to ask about one of those numbers first versus the other. But the average VC investment is about 8.5 years. Do your diligence on them and try ideally to get an intro. That doesn't mean white middle-class male went to the same school. It means going through a lawyer, an accountant, a corporate finance advisor, someone who, if you don't have that network, can actually go and connect because you just need to stand out. In the time I've been here, I've had 3 pitch decks land in my inbox on that side, but none came from a connection. If I'm time pressured, and I always am, that will be really important. In terms then of core metrics to showcase, we'll always look at capital efficiency on that side. So you can use sort of rule of 40 or other proxies on that. We'll look at, particularly for more consumer businesses, contribution margin, and particularly CM3. And if you don't know what that is, I would strongly advise Googling that. So we're looking at the unit economics. We don't expect those businesses to be profitable now, but if you haven't got really strong unit economics, when are you ever going to be profitable at scale?
Vinay?
I'd agree with all that. So I have to say something different, don't I? Which is the disadvantage of sitting at the end of the panel.
We'll go the other way around in a minute, don't we?
No, it's okay. I'm fine sitting here. All right. So I think I like a good story, and I think the founders who captivate you, or the teams that captivate you with the best story, which has integrity. It may not be fashionable. It may not look like, the sexiest thing, but I like the story. And often, if you've got a really, really good story around, like, the unit economics should make sense. The investment needed should make sense. There should be some traction, and actually. And if it's done with a lot of integrity, then that should really be a strong argument. If you've done the thinking and the work and applied some thought, you should have a great story. So if you haven't got a great story, you're not happy with it, or there's some clear bit that's clearly, you're uncomfortable with it. It needs fixing. So.
Perfect. My next question was actually going to be, what's more important, the founder, the execution, the idea? I think part of what we come to is they're all important, if we're getting a nod of heads along the panel. But you as a team, you're making the rest happen, and therefore you're important. So if anyone disagrees with that, jump in and correct me, otherwise I'll move on to the next question. Okay, I've nailed it. So my next question is... You see a lot, actually just been talking, how many pitches you guys all see. What's the biggest mistake you see founders making when they first send you a pitch deck or they're first presenting to you guys? Vinay?
I think one of the ones I see often is might be linked to the story point, is the lack of kind of like sometimes the unraveling of possibilities and what the thing really is. That could be it could be a competitive pressure. It could result into a unit economics problem. It could be like it's not actually a big enough service because there's a big gorilla in the room which it could easily copy the service. But sometimes that thinking, I would say that's the biggest mistake. It's really deep thinking around the possibilities of the business. I think that's probably the biggest one I see.
Ashley?
So there's a couple from different perspectives. I would happily agree with that on the sort of what's the vision bit, but a couple of immediate switch offs coming back to the numbers point. VCs are looking for a reason to say no. And actually, I will look at that pitch deck as of this should be a really important conversation for you. It should be more important than any one sales conversation, anything like that. So I will be anally retentive on things like spelling mistakes, formatting errors, maths mistakes, where your numbers don't add up across the slides. That really stands out. And that's not a case, I'm not backing anyone to be good at PowerPoint. Coming back to the Teams point, if you're dyslexic, you've never used PowerPoint or something like that before, fine. But if you can't go and find someone in your network to help you, go and ask for assistance, review things, look over it, how on earth are you going to be able to build and scale a team? It's one of those indicator points on that. Then within all of that, as Vino was saying, the sort of what's the actual clarity of all of those slides? There's no such thing as the perfect pitch deck. They are different for different audiences, and don't be afraid of having different pitch decks, one to stand up and present, one to email out. Don't be afraid of an appendices on things like that. You can always just reach out to a VC and ask, what do you want to see? People will be different on that, but it actually makes you memorable. Very few people ask me what I want to see in a pitch deck on that side. But whatever you put into any sort of pitch deck, just ask yourself, what is the so what of that slide? Why have I put that one slide in there? And if there isn't a really clear reason for that slide and a really clear message that you can explain in one sentence, probably shouldn't be in there.
If I can go back to what Vinno was saying about the story, I think for me, one really good piece of advice that I was given when I started investing was that most small businesses that we're looking to invest in, if they're going to fail, it's because they've died of indigestion, not starvation. It's because you're trying to do everything. It's because you've got so many ideas and you need to pick one and you need to have a strategy. And you can say, if we had a bit more money, we might explore this. And if we could do this, then we'd do this. But we need to see your clarity of vision, and we need to see what we're backing and what the plan is that we're backing. Because ultimately it's your business and you're the ones who have got a really deep understanding of the market and where you sit within it. We need to see the vision.
Yeah. And I think me and Ash were just talking about this before, which is, I think, a lot of people look at pitch decks and they go, I'm not getting a response which might well because there's lots of errors in it. It might be well because it doesn't convey the story well enough. But a pitch deck is there to get you through the door to go and speak to these guys and have a face-to-face so they can assess you as a founder, they can assess your ideas and your things. So a pitch deck's never going to win you investment, but can definitely lose your investment. I think that's something that's very much worth considering when you're going in and approaching from that. So on that theme, we'll start in the middle this time with Ashley. What's the most common thing that you wish founders were putting in their pitch deck so you could look at it that they don't? And you just go, why? Why have you not put that in there?
Oh, that's a relatively easy one. And to just put some more numbers around that for context. So of those, say, 1,500 pitches, we might only meet with 500, maybe 400 times a really precious commodity on our side. So it needs to be a good enough pitch deck to get the meeting. If it's not good enough, that's a gate, but it doesn't get you the deal by itself. The bits that I wish for most in pitch decks is actually detailed financials. And that doesn't mean I need a 50-line P&L balance sheet cash flow, but I want to have a lot more than just a pretty chart that shows revenue going up and to the right. I want to know, I see far too often, sort of one of the things is, how much cash do you need and how much are you going to need in future? What is this raise getting you to? And so many questions could just be answered with just a pretty decent summary P&L of sort of revenue, gross margin, operating costs, EBITDA, and then just a sort of cash flow bit. Is this giving you 6-month runway? Probably not worth the conversation. Is it getting you to profitability? You could put slides and slides and slides in, or just give that financial information there. It's particularly important for any fund that has a revenue screening criteria, which is most of EIS and VCT funds, for example, in the UK, a lot of early stage and then later stage as well. Make it easy for us just to go back, not just and say no, but then being able to go, actually a better time to have a conversation will be in a year or so when you're at this level. And let's pick up again in sort of June next year, for example. That's a much better response to get them to just go, no, you're not ready yet.
Perfect. Lucy?
Yeah, I think I definitely agree, detailed financials. And I think it's also to the point that it's not just a case of, we do need to know that information. It's also, it really speaks to you understanding your own business. And if you can articulate, if we then say, okay, so you want this much money, you're going to build out the sales team. How many people do you need? How much are you expecting them to sell each year? How long will the sales cycle take? All of that data shows that you've really thought about it and you really understand it. And then that gives us more trust in you to be able to deliver on the plan.
Vinay?
One device I've been using, particularly in situations where you're navigating complexity, is because there's a lot of complexity, and I think opportunities sit in the kind of zone where there's complexity. Like they might be sitting between two disciplines. And by the way, I completely agree on this financials point. Sometimes getting detailed financials like getting blood out of a stone, which is like one of the central things of making an investment. But one idea I have, which I've not seen actually, is you should put in a Q&A, like a few pages of the most like why am I attacking this market? And the kind of like, it's even the more insane you're doing, you should have like this is why I'm doing it. And it might convey both the story, the narrative, the questions going through people's heads, and cut through the information overload we have. And I use this as a device in managing the many stakeholders I have. I use Q&A as like it's literally like you should ask any question you could possibly think of that's going to shoot your thing down, because what it shows is you're willing to lean in to the challenges, they're always going to have challenges. And I think that's also quite a fun way. I'd love to see it.
I was just going to say, if I may, the most impressive pitch I've seen in my 7 odd years at Guinness was they had a really decent pitch deck, but then they followed it up with a Q&A deck. There was about 50 odd pages of just, here's all the questions we could think of, and here's the detailed answers. And they had a financial model and the deck explaining their financial model, the underlying assumptions, everything like that. It was the same level of thinking that I suspect all of you guys will be doing, but they just put it down. And it was no coincidence that's been the most competitive process I've ever been involved in on that side. It's the only time I've ever celebrated properly with champagne signing a term sheet on that side, because it was so competitive, such a professional team. And it's all of that sort of subtle messaging that comes through from that. It was also the fastest investment committee paper I've ever written because I just had everything. I could literally just copy and paste, and speed is really important in that. They made my life so easy, and that's what you want from an investor perspective.
Yeah, I don't know whether you guys agree, but I think I see this from my perspective sometimes with people when I'm talking to them about whether it's selling their business or raising capital, whatever it is. You're giving an impression every time you meet people, and I think what you'll see is some founders want to go, I'm so busy because we talked about this before, I'm doing everything, and therefore they're not available. And they want to go, I can't look like I'm available to go and meet the VC tomorrow because they don't think I'm doing anything. And it's like, that's obviously ridiculous. You've grown a business. So actually you have to think about how you act and how you present, sending a Q&A deck, which is thought and help them out. It's people to people. People sell things, the way we all know that. And therefore, actually, if you can go out there and make somebody's life easier, of course they're going to want to do that deal. Put 2 deals in front of them. Sure, you guys are going to nod your head. One gives you everything you need. One you have to ask loads of questions. They might be identical, but they're going to go for the easy one because that's what you could do. Probably let's go to a question that I reckon a lot of people in the room will be thinking of. They're thinking of raising: valuation. So what would your advice be when founders are thinking of valuation? Probably very critically, I think we're all going to say similar things, but what should they not be thinking about, and what do they get too hung up on when you start talking to them about valuation? Lucy, we're going to start from the side.
So I quite often look at business. There are 2 scenarios here. There's the when you're going in, and then there's the when you're coming out. And I'm assuming we're mainly thinking about the going in this room. And then I'd say it's really easy to get excited about the big number at the top. So I've got two main pieces of advice here. Number one is write down a number in an envelope and put it away. And then if you start getting very, very excited about big numbers and the deal starts to look like, oh, maybe it's not going to quite get to that really, really big number I got excited about, but it's a lot higher than the number I had in that envelope, it's probably still a very good deal. And the other side is the number's only one part of that whole package, and you need to look below the hood, and you need to look at the structuring, and you need to look at the amount that they're taking of the equity, and you need to look at the downside protections and the controls they have in place, because 9 times out of 10, that's the really important part about the term sheet you're being offered.
Vinay, we'll go across to you.
Well, I want to come back to what Ashley was saying, talking about the team and the founder. What really makes a great company is actually probably doing something, and maybe the story bit is probably doing something that you really want to do. Because I think the valuation becomes kind of like a psychological or emotional device, right? But really, you might be doing this and it might not work out. That's probably the odds. So are you doing something that you're going to enjoy? And then the math is probably look at like, well, how much you need then from your salary and some form of upside to be happy doing what you're doing. And the further you are away from doing something you really want to do, right? You might have change your psychological kind of know how much you want to be paid to do that. But in the main, if you're doing something you want to do and spend your days building this thing, then the valuation is slightly, you just need the funding, and you should be fairly pragmatic on what it takes, because it just depends. Like, because if you're doing something archaeological, say, which you don't see many pitches on archaeology, but that might be the thing that makes you happy, and you might find some foundation who's going to give you the money to do this thing, right? Dig up for more dinosaurs and find some commercial model, and then maybe and that's great, but that's got to keep you happy. So I would just say, I think about your happiness and your emotional relationship, what you're going to be doing, because in the main, in many instances, you might be doing that for a very long time.
Yeah, I'd sort of echo what's already been said. Just put some more colourful language around it, is work out what your fuck off number is, which if someone says, I need you to go and do something, you've actually got enough liquid income or savings to just go, fuck off, I don't need to work again. And for a lot of people, that tends to be somewhere between 2.5 and 10 million, depending on what sort of lifestyle you want, particularly school fees and whether you want a really nice home in the countryside on that. But it's not a stupid, unattainable number. As Lucy was saying, it's a balance between economics, control, and the emotive side of things. I could offer anyone a sort of unicorn valuation tomorrow, but it's going to have 100 tons pref stack. I'm going to control everything. You're not going to be very happy, to Vinay's point of view, and it's going to probably be a really shitty deal on that side. So work out the in-between bits. There's a really good resource online, which I contribute to, so I definitely have a vested interest. But the HSBC Innovation Bank term sheet guide that comes out each year is about as close as you'll get to what the market standard in the UK is, and really breaks down the differences between the sort of the economics, the valuation, the control point, what is a typical pref, what are all of the other sort of consent rights on it. The other and last bit I would leave you with on valuation is, as founders, you can get more equity later as options. Dilution on day one is not the be all and end all. If you are still really integral to that team, and a good founder should be, you can just get topped up later and have different incentive structures on it. It's not a one and done.
Can I just add to that as well, with the other thing to think about is the future, because you're probably going to want to do multiple rounds. So it's not all about getting the highest, most exciting valuation on your first round. It's much better to have a story where your valuation is growing over time. And to the same point, I'm thinking with my VCT hat on now, sometimes you'll reach a cliff edge. So for example, with VCTs, there's only a certain amount of money you can actually take. And then after that, you need to get funding from other sources, like a normal private equity house. And sometimes you'll find there'll be a valuation dip at that point, because VCTs have a certain amount of competition against each other. So there is a valuation dip after that point. So you'll want to think about how much capacity you have for that kind of investment, and you'll want to think about the long-term trajectory of where you want your valuation to end up. It's not all about just the first round. It's a long, long, long journey.
Also, like it's in success. Even if you do a bad first deal, you're probably going to do great, right? So it's only really when you don't have that linear top right corner path that you need to think about some of the things I raised. So.
Yeah, I think I'd say, just echoing pretty much what every one of these guys is, when you're getting invested into, it's paper. And until the point you sell something, you could have a business. I've seen this. I had somebody who's making £5 million profit a year. So they did well. They took some money out along the way. We were literally talking with a buyer, and that buyer rang me up and said, we're thinking of offering $35 million for this business. And I said, that's not enough. We want $50 million. And he said, I'll go away and have a think. The next day, that founder rang me up and went, Google's changed some things with its algorithm. We're no longer making $5 million a year. We're probably making $1 million a year. And then a few months later, he was like, we're no longer making $1 million a year. We're making nothing. And then probably 2 years later, that business died. Theory, he was really close. He could have started spending that money and he could have been there. I'm worth £50 million. I'm going to start reserving my yacht. Until that point, that money's in the bank account. You are not worth it. So you can have a great high valuation, as you said, with loads of stacks. Doesn't mean you're going to get that at the end. So really have a look. And I think one of the things I would say is think about yourselves. You're entrepreneurs. You're going to have a high risk profile. But what's your risk profile? If you're really worried about getting some money out at the end, don't be going for stupidly high valuations because they sound great. Be protecting yourself on the downside in outcomes. If you just go shoot for the moon, fine, go for that. But you should be thinking as an investor yourselves, what do I want out of a deal and where are my pressure points? And that should be something there. I'm going to throw this to Vinay because it's slightly focused towards you. But these guys invest capital, cash into a business. There are different methods of funding and views. So I want everyone's on the panel's view of the thoughts of taking different views, whether that's debt, like you do, using media for equity, different options. So you're obviously going to be biased, but what do you think?
Well, it's still capital, right? So I'll just stay curious. I think around the options, that's my advice. Specifically with media for equity, I think it's coming back to my opening line, consumer. And so is it a good time to raise consumer money right now? I'd say it hasn't been for the last 3 to 5 years. The single biggest reason of that is because of the funk that investors are in, but also the lack of understanding around marketing and marketing strategies. And specifically, I've got something that activates marketing strategies because it's different, it's complementary, it ignites digital, it makes digital cheaper, it helps you manage when Google changes its algorithm. And so if you're curious about that, and then of course I have quite a lot of fun, right? So in a way that I think many funds can't have fun, right? I can mold my structures quite creatively in a way. I think that that's a joy. And we do quite radically new structures to get in early, help companies on their cash flow, take multi-staged investments so that we write large checks to give widespread awareness so that you can become top of people's minds quicker, earlier, and that's where the industry's going. And the future of media for equity will be that there's no question that in the future, whoever's sitting here or me will have 10 other publishers working, all investing in the same. That's inevitable. That's just going to happen. But I can't speak about in terms of the debt and the venture debt side of things. We work with them. I think they're similar sometimes, and you should just stay curious. There's quite a lot of options out there. I'm stunned by how much HSBC is doing. It seems, right? So, they're everywhere, right? They're not here though, but yeah,
a lot of marketing budgets.
Yeah. Ashley,
so I'd say everything's got a cost to capital. Some you might see really obviously, whether dilution, interest rates, others you might not down the line. Important to think if you're having or considering any of those options, you're already not a perfect business. I will never be able to invest in a perfect business because a perfect business never needs me and never needs any of those options. So already just start from that level of realism and then just work out the pros and cons. There is not a one-size-fits-all approach. Venture will be good for some, and even then you've got different types of VC, whether EIS, VCT, straight LPGP, for example. What are the strings? There's always going to be a string attached of some sort. EIS, VCT will largely charge arrangement fees because of their business model, but then they won't have a lot of the sort of control points on that side. Debt can be very painful if it goes wrong. I've seen it go horribly wrong. Equally, it funds and provides the liquidity for pretty much the entire private equity industry, which turbocharges growth on that side. Media for equity, as Vinay says, can be phenomenal. What happens if it runs out? There's pros and cons for everything. It's work out what is right for you. You want optionality on that. There isn't any perfect bit. Arguably, you'd say debt tends to be better for later stage than really early stage. But what do I mean by debt? There's a big difference between term debt versus a sort of revolver or invoice financing sort of overdraft type facility just to help with working capital. It's look at all your different options, go and ask for advice and just put them all into a spreadsheet. And if you're not good with spreadsheets, find someone who is just to talk you through them and work out what is best for you.
I haven't got much to add to that. I think, the main thing is everything has strings attached. So work out what the strings are and work out what suits you best.
Yeah, and I'll just give one more story, coming back to the storytelling point. But there's a business I knew that was going out to raise Series A a few years ago. I think Ashley might have looked at it might not remember, but a long time ago. It was a very good business. I think most funds would have invested into it. It was at break even. It was growing nicely. It had a good but not huge market that it was going to go into. They'd taken some money from left field. So it was a PE fund that doesn't usually invest in this kind of stuff, had invested in a very creative way. There was about £6 million of debt on the balance sheet. No institutional investor was going to invest in that now because they would what we call ranking behind. So if the whole thing was sold tomorrow, that debt gets paid first, then the investors start earning that money. It's too high risk. And therefore, he blocked himself. At the point he took that money, it sounded great. Oh, debt. Oh, you're not going to get diluted as much. And it's all going to be amazing. He put himself on the track. And I think people make these decisions, you guys might agree or disagree, but I think I see most of the actual mistakes founders make are at the early stage around angels and things. They'll do strange things because it sounds great in a moment and they just hamstring themselves later on. So I would always say that if you've got a friend who knows something about this world, or if they don't, try and find somebody just to ask a question. You don't need to hire somebody for it. Just ask some questions to make sure you're doing the right thing.
Just ask Andy.
We'll do it for free, honestly. But going on to the next side of it, we haven't got much time left. I'm just going to ask for a very short answer from everyone, which is what... Actually, you know what? We're going to do one sentence. So from people you see, what's the one thing you'd say to founders, stop doing this immediately? Can be to do with investment, can be to do with anything, but you just see people doing something, you go, please stop doing that. Lucy.
I don't have to say in one sentence. I want to see a consistent story. So I don't want to see, we want 10 million, we want 5 million, we want 2 million. That tells me something's gone wrong somewhere. I want to know what you wanted and what the plan is.
Yeah. Ashley?
Can I do two? Because one's really quick. The first one is don't be an arsehole. And that might sound really sort of like no shit, but you would be surprised at the number of times that I've been sworn at, shouted at. People have demanded to speak to my manager when I've said no. That's not how VC works. On that side, you misspell my name repeatedly in an email while demanding to speak to my manager, you will become an anecdote and you're not getting through on that side. So actually, that would just be one bit. The other last bit is don't be disorganized. Momentum is so key. If I will see 20, 30 opportunities a week sometimes, if I meet you and I follow up and go, right, I want to see all this information, etc., have it ready. It could take you 9 months to raise, but only 3 months actually out on the road. if it's okay, I'll get that to you in sort of 3 weeks' time, I'll have forgotten who you are. I'll have had so many conversations. So don't be disorganized.
Vinay?
I agree with the don't be a dick thing. That's a major one, right? So, but it's really a sense of what kind of team you're going to build, how you're going to handle a major contractual, commercial, banking, financing partnership. It's just like a total red flag. I don't like it when people say, well, my real answer is, I don't like it when people say, we're the Netflix of this, or we're the Spotify of this, or the Airbnb in this. Like, they're 15 years old. I think we just have to, that's moved on. Like, we've got to kind of like, don't use that. Yeah, it's just a pet hate of mine. So,
yeah, and I think I'll just say, if people turn you down, there's nothing personal. Don't be a dick back, because they might well be the person to give you money in the future. So you never know. Just leave all your doors open and take that. We're out of time for this panel. So I'd like to thank all of the panelists for sharing their things. I think it was really useful.